Adani Group stocks see a sharp recovery after opening with deep cuts for the second session following the indictment of billionaire Gautam Adani and 7 others in the United States. All stocks sitting with cuts of anywhere between 2 to 5%.
Protein ECAF is down nearly around 7% after the National Stock Exchange is set to sell its 20% stake in the company via the OFS route.
Sobha is up in today's trading session, up nearly 2%. HSBC gives a buy call with a target price of 2150 rupees. Brokerage says the company is poised for strong growth after its recent rights issue and improved cash flows.
Info Edge shares surged nearly 5% after Goldman Sachs upgrades the stock to buy from sell. They raised the target price to 8,600 from around 5,700 earlier. Hello and welcome to Chartbusters. I'm Nigel. With me is Mangalam. Well, and the bulls seem to be partying on this Friday morning at least. The Nifty is up close to 200 points. The Nifty Bank that went ahead yesterday and defended the 200 DMA, that looks like the one that's ready to fight for the bulls. And also the IT index, keep an eye out on that one. That's up close to around 1% as we speak. So big up moves is what we're seeing. Well, Mangalam, it's a good morning. And, getting to this weekend, I think the street is anticipating that the BJP has done fairly well in the state elections. And there could be some pre-positioning as well that plays out. We'll watch out for how that plays out in the second half of trade. The first half definitely has gone to the bulls, especially after the drubbing that we've seen over the last few trading sessions. A lot of these high beta names are doing well. You spoke about banking and IT, but keep an eye out on a couple of these real estate stocks. So from the broader markets, we have DLF, which is up around 3.5% odd. Godrej Properties itself has recovered a fair bit from lows, currently at the high point of trade. Sobha, we've been talking about that bullish note coming in from the likes of HSBC. So a bunch of these real estate stocks are doing well, and alongside that, PFC and REC have both bounced back as well. We'll keep an eye out on how these stocks pan out. And the other one that I'm looking at is Havells. That too has recovered from the lows at the high point of trade. So we'll keep an eye out on all these, individual names. The broader market's looking a lot better, even though at an index level, the mid-cap index is up just about 1/3% as against the other indices, which are up 1%. If you look at the crisscross lines, which are not crissing or crossing, we have way more stocks advancing for the number of stocks which are declining. Almost 1,700 stocks in the green for about 700 in the red itself. Let's talk about the new kid on the block. Truck operating platform Zinka Logistics saw a decent debut, listed at about a 3% premium to its issue price, but thereafter saw a bit of a sell-off, currently sitting at a 3% discount to its issue price as well. To discuss the company's post-listing plans, we have Rajesh Yabaji, the CMD and CEO of the company, joining in. Rajesh, congratulations. A momentous day for your company to be listed on the bourses. Irrespective of today's moves, it is definitely a moment that you will remember with all your teammates as well. But let's talk business. Tell us a little about your current revenue mix across load management, payments, vehicle financing, and what are the kind of take rates / margins that you make across all these verticals?
So thank you so much for having me on the show.
Yeah, go ahead.
Thank you so much for having me on the show. Right. So, as a company, you're aware, we are a company which is, which dreams about trying to build a new world of trucking. And, to get there, we as a company are trying to solve the problems for the fleet operators in the country using a platform approach, helping them, get digital, helping them simplify their operations, and get more earnings by using the technology platform which BlackBuck has built. And as a company, I think, our core offerings of payments and telematics, which were basically the first launched offerings initially, form a large part of the revenue as even mentioned in our prospectus, right? And because of the nature of businesses we are in and the nature of revenues, what we make is largely technology kind of revenues, platform kind of revenues. Most of these come at a very high contribution margin of 90 to 93%. And because of the nature of these revenues, which have high level visibility, because you acquire a customer, you know that the customer is going to be there on the platform for a very long tenure of 5, 7, 10 years. And then there's a high visibility of revenue. And these revenues are generally recurring in nature, so you don't need to really invest in substantial amount of sales and marketing. Every time you generate revenues, we only put sales and marketing to generate newer customers to the platform. The older customers continue to compound on revenue. Because of the nature of the business, the technology based revenues, our contribution margins in any business sort of range between 75-80% to as high as 99%, with a blended contribution margin profile of 90 to 93%.
Right, Rajesh, but the stock market likes cash flows, the stock market likes EBITDA, the stock markets like net profits. Despite the high contribution margin that you're talking about and large market share, you're still EBITDA loss making, operating cash flow negative, and your first quarter net profit too has come in from exceptional gains. So you want to understand about that, while you are acquiring customers, that too at a high contribution margin, there is operating leverage playing out with visibility, etc. That's not showing in your numbers in terms of at least the operational profits or the net profits or even the operational cash flows. So could you give us a sense of when you intend to be positive on all these fronts?
Yeah. So, number one is we as a company are PAT profitable in the first quarter, even without the exceptional item. That's point number one, including all costs, ESOP costs, everything, number one. Number two, operational profitability, which we measure through adjusted EBITDA, which is also the indication of cash flows. We have been fully profitable for the last financial year, and we made close to about 19 crores in, adjusted EBITDA in the first quarter. And our cash flows, like last financial year, with an adjusted EBITDA of, about 13.5 crores, we made a free cash flow of 45 crores. So because of the nature of revenues we have, our adjusted EBITDA is what mimics the, free cash flows. So as a company, we've been consistently throwing, money in cash flows, over the last, 4 to 6 quarters, and we'll continue to do that. And because of the nature of revenues and the operating leverage, because if you can see, last financial year first quarter and this financial year first quarter, the growth in contribution profit flew down into the EBITDA margins, like with an efficiency of like 75%. So that kind of a play is going to happen as we keep building the company, and that will drive consistent profitability of the company as we step into the future.
Rajesh, good morning and welcome to the show. This is Nigel on this side. You've given us a fair insight into business, take rates, contribution as well. Give us two numbers. The sustainable growth rate that you're looking at, that's on the revenue front. And according to your calculation, what should the margin look like?
Yeah. So, can't comment obviously on the future numbers. If you look at...
Why? You can give us an aspiration, Rajesh. Now you're listed, you can give us an aspiration.
Sure.
Nothing wrong with that. Regulators are going to be okay.
Of course. As a company, we've grown in the first quarter close to about 60%. Last year, we grew like 70%. So we continue to compound on growth. Customers keep, we acquiring customers at a, better pace, similar paces as previous years. And so hence, so growth is the mantra. We, as you guys know, we operate like multiple different service offerings. And today the revenue largely comes from only like 2 core offerings. The remaining offerings are scaling at a very fast pace. So you can definitely expect the revenue to, keep compounding, on the similar lines. And if you, put a math on operational leverage there, because the company, really is not investing in, factories or does not have like assets, because, the ROE of the company is going to be, very high because there is no deployed assets in the company as we keep moving forward. So using the operating leverage methodology, you can, you will be able to understand where we will be in the steady state margin profile.
Got that. Take that point, Rajesh. Thank you so much for joining in. What we'll do is we'll probably invite you once again for a longer conversation to try and explain to us what your business is, more importantly, how the operating leverage plays out as well. But for now, straight, we'll just look at 50-60% growth. All right.
Absolutely. All right. Thanks, Rajesh, for joining in and filling us in with all of those details. I'll tell you what, we'll slip in a short break. On the other side, we'll be joined by Manish Jain, who's the Managing Director of Enviro Infra Engineers. He'll discuss the company's IPO plans. Stay with us.
Welcome back. You're watching us here on Chartbusters on CNBC TV 18. From an issue that just listed to an issue that has just opened. The primary market action. Enviro Infra Engineers IPO opens today. Will close for subscription on the 26th of November. The company is actually, planned to raise about 650 crore rupees, between 140 to 148 rupees as a price band. And at the higher end of the issue price, seeking a market cap of close to around 2,600 odd crore rupees. Manish Jain, who's the managing director of the company, joins us now. Thanks a lot, Manish, for joining in. Just a couple of questions first up. One of the objects of your issue is to actually repay debt on the books of the company. So if you could tell us, how much is the debt on the books as of now, and what will it be once you repay the debt? And secondly, what is your current order book?
Good morning. Good morning for having me on the show. The total debt of the company as on 30th of June is 300 crores. So we are doing projects under EPC as well as HAM.
I think we've lost the connection out there. We just repatch that connection. So the company obviously is into wastewater and sewage treatment. Last year they did revenues of close to around 700 crores with profits of a little over 100 crores. And we will get to know a little more about their order book and the objects of the issue as well. They are looking to, repay some of the debt that they have on their books with regards to this. The management has said that it'll be about 200 to 300 odd crores as of June. What we'll do is take a short break, come back, and on the other side, we continue our conversation with the management of Enviro Infra.
Welcome back. Well, let's get chatting with the management of Enviro Infra Engineers. We have with us Mr. Manish Jain. Hi, Mr. Jain. You were telling us the total debt in your books is around 300 crores. Out of this issue, 120 crores will be paid back. So post the payback, the net debt will be in the vicinity of around 180 crores. Could you confirm that? And on this 120 crores, what will the interest saving be?
Basically, on a standalone basis, the overall debt in the books is 210 crores. So we intend to repay a term loan of 120 crores. So standalone basis, the turnover, the term loan in the books that shall remain will be somewhere around 90 crores. Further 98 crores that comes from the term loan from our HAM projects. So that HAM project term loan that will continue because these are in SPV books. So that is a subsidiary of the Enviro Infra Engineers. So those term loans in itself will continue. Going forward, this is one of the HAM projects which the company has already executed. There is one more HAM project for which the company shall be taking up that project in future. It is a Mathura HAM project for which we have earmarked the equity contribution of 30 crore from our from the IPO itself, and then there is a working capital requirement of 181 crore which is proposed from this IPO.
All right.
What is the interest savings on the 120 crores? You were borrowing at 10%, 11%. What was it? So effectively, you'll save 12 to 13 crores is what we understand.
Yeah, the main purpose is not that interest saving, rather than it's a cash flow cycle where we are more concentrating on. So the cash flow cycle requires that because we are doing government projects, so we are required to furnish bid bond guarantees, performance guarantees, and retention securities, for which we are having working capital limits from our bankers. So the ultimate purpose, because all these working capital limits are backed by FDRs. So in future, we would like that the margins which we are required to put into our banks, going forward, our credit rating, which is currently A-, gets further improved so that the FDR margins and the collaterals that get reduced. So that DC came to reduce it and then bid on a strong balance sheet for further HAM project we can bid forward. Thank you.
You speak about your cash flow and working capital as well. You know, working capital days have been very stretched in the last couple of years. Cash flow from operations was negative in FY24. Could you tell us what is your working capital cycle right now, and where do you intend to take this with this infusion that you're doing in your books?
The net working capital gap for FY24 is 40 days. So the total cash conversion cycle, which includes inventory days, unbilled revenue days, and then debtor cycle is 160 days. And the creditor repayment days are 120. So the net working capital gap is 40 days. We understand that we are making the payments to our MSME vendors within 45 days time, and non-MSME vendors within 60 days time. So we expect that the working capital cycle going forward, it will get reduced to from 160 days, the cash conversion cycle, which is presently 160 days, it should come down to somewhere around 140 days time.
Got it. Can you tell us a little bit more on business? The WWTPS and the WSSP, both those two are the verticals that you have as of now. How do you see the mix changing going ahead?
Basically, there are three types of treatment plants. One is sewage treatment plant, where is the domestic waste which is being treated. The other one is the industrial one, wherein the wastewater emanating from various industries in an industrial cluster, it is treated. So that is a common effluent treatment plant. And third one is the potable water which is coming to our houses. So the water after being drawn from rivers is taken to a plant, treated, and then supplied to our homes for drinking purposes. So basically, there are these three types of plants along with its schemes. Scheme says that the pipelines and pumping stations which are required to be constructed. So this constitutes the entire scheme then. So this is the area, and company exists in all the three segments. Company is driving the growth backed by its strength in its designing capabilities along with the execution capabilities. We are having a team of 180 plus engineers. Myself, my elder brother, and the chairman of the company, Shri Sanjay Jain, we both are chemical engineers. So process engineering and designing has always remained our USP. And we are being backed by a team of professionals in our company. So we are doing the entire designing in-house. Along with this, the execution of the projects is done in-house. So we are able to execute the projects well in time, remain ahead, and the EBITDA margins and PAT margins that are being maintained for the past 3 years consistently.
All right, we take that point. We'll discuss more on your order book, your revenue generation, and your execution over the next few days when we converse with you, when you list. But up until now, thank you so much for joining in. Wish you good luck for the issue, Mr. Jain. With that, we're out of time on this edition of Chartbusters. You stay tuned to CNBC TV 18. Trading Hour comes up next.